Hello everyone, welcome back to Believer Science Academy. This is topic of the day discussion session. In this topic, we'll be discussing a very important topic from UPSC mains, prelims, and interview perspective. That is depreciation of rupee. Okay, so if you open Twitter or if you open a newspaper, one of the hot topic that is happening in present days is why is rupee depreciating against dollar? Why is the value of rupee going down against the value of dollar? Okay, we'll see the reasons. That is, major reasons behind this one is mainly exit of foreign portfolio investors, that is FPIs withdrew substantial investment from Indian equities in 2024, leading to selling pressure on the rupee. Okay, when the portfolio goes away, that acts as a flight capital, which will have an impact of selling pressure on the rupee. As a result, it is reducing the value of rupee against the dollar. Then, outflows reduce the demand for rupee in the global markets. This is very important. Whenever the rupee or whenever the investment is outflowing from India, it it is an indication that the demand for Indian rupees or demand for local currency is reducing, because that indicates that the economic condition of the country is not a ripe economic condition of the country is not in such a way that we can go there and invest. Okay, it gives a bad indicator. As a result, more and more investors tend to sway away from India and invest somewhere else. Whenever you are not investing in India and investing away, then you are reducing the demand for rupees and increasing the demand for foreign currencies such as dollar. Then widening trade deficit, that is high imports of crude oil, gold, and other essentials have increased India's trade deficit. What is trade deficit? Trade deficit is equal to export minus imports. So India traditionally has been an import oriented country economy, so imports are always high where compared to exports. When exports are high and imports are less, then the demand for rupee is less, whereas demand for dollar is high, because in exports and imports you tend to sell and buy in like dollars. Okay, when you are involved in more imports, you have to buy goods at a dollar rate. Okay, so there is a demand for dollar is increasing, whereas when you are selling in exports you will be selling at the cost of rupees, so that export increases the demand for rupees. Since the trade deficit is high, demand for dollar is increasing, whereas demand for rupees reducing. A larger trade deficit increases demand for foreign currencies, especially US dollar, to settle import bills, weakening the rupee, as I already explained there. Then, other reasons include monetary policy differences. Okay, United States Federal Reserve's tight monetary policy. Federal Reserve's tight monetary policy, that is high interest rates, has attracted capital to the US, strengthening the dollar. Okay, whenever there is high interest rates, meaning if you are investing in USA, you are going to get higher interest. Okay, higher returns. So whenever there is higher returns in USA, most of the people tend to invest in USA rather than investing in other countries. Okay, so USA or USA economy is so high, that so powerful, that the monetary policy of US Federal Reserve has implication all over the world. Okay, then in contrast, RBI's relatively looser policy has made Indian assets less attractive to foreign investors. Okay, whenever the monetary policy is tight, it means that the currency is hard. Hard in the sense currency's demand is high. Whenever the monetary policy is weak, it is the general feels that loose currency or soft currency. Whenever the currency is soft, it means that demand for that particular currency is very low. That is what we are witnessing in case of India. Then, apart from this, there are global economic factors as well. Due to geopolitical tensions such as Russia-Ukraine war and Israel-Palestine conflict, the rising crude oil prices have created global uncertainty, prompting investors to seek safe haven assets like the US dollar. Okay, since the oil prices are increasing, import bill on India is also increasing. Also, instead of investing in risky industries elsewhere, people tend to invest in safe haven, that is US dollar. That emerging markets like India face capital outflow during such periods because they tend that during these issues, these times, the economy of emerging markets is going to collapse. So, in order to safeguard their money, they tend to invest in rich and powerful countries like USA. Other reason is strengthening US dollar. That is, higher US bond yields have made investments in the USA more attractive, boosting demand for the dollar relative to the other currency. Okay, I have told you already. So if you are investing in USA bonds, if the returns are high in USA, why would anyone go from USA to other countries where there are higher risk factors? Okay, whereas in USA the risk is low but the yield is high. Okay, since the yield is high, risk is low, obviously more logical person would go to invest in USA rather than investing in India where risk is high, yield is less. Okay, if the risk is low, yield is high, then the demand for dollar goes on increasing. If the demand for dollar goes on decreasing, then the demand for rupee goes on decreasing. Okay, then so if those are the reasons for value depreciation of rupee, then what is the impact of this rupee depreciation? Okay, it has a wide range of implications on economy and security as well. So first one, obviously, it will increase import cost. That is, a weaker rupee makes imports like crude oil, fertilizers, and edible oils costlier. India's trade deficit hit a record 37.8 billion in November 2024, further stressing the economy. Okay, then it will have a inflationary pressures. That is, higher import costs contribute to domestic inflation, raising prices for essential goods like food and fuel. Okay, since you are importing it at a higher cost, obviously the people who are importing are going to transfer that cost into the consumers. Okay, they are going to transfer that burden to the consumers. Okay, so the consumers, the citizenry are going to face the burden of this rising cost, which is a inflationary nature. Then reduced purchasing power impacts consumer spending as well. Okay, since the purchasing power is less, spending is also less. When the spending is less, then the investment is also going to be less. When the investment is less, then the economic growth will be less. So it has a vicious cycle there. Then obviously the next point is slow down in economic growth. In recent video, we discussed that is India going through economic slowdown? Is India going through a structural or cyclical economic slowdown? We discussed those aspects in the previous video. Okay, now we will see one of the reasons for economic growing slowdown is depreciation of rupee as well. That is, rising inflation and higher borrowing costs can deter investment and consumption. This creates a drag on overall economic growth as well. Then impact on the corporate sector, that is, companies relying on imported raw materials face higher costs, potentially reducing the profitability as well. Then firms with foreign currency denominated debt may face increased repayment burdens. Okay, because rupee is increasing, sorry, dollar is increasing and rupee is reducing, or rupee value is reducing, meaning for $1, whenever you purchase something, for $1 the rupee was 60 rupees. Okay, $1 it was 60 rupees. Now after certain period of time, now for $1 rupee has reached to around 86 rupees. Okay, you have borrowed something, now you have to return it. Whenever you are returning whenever you are returning in the foreign denominated currencies, you have to spend extra 26 rupees. Okay, so who is at the loss here? A person who has invested in foreign currency denominated debt. Okay, then so what is the role of RBI in this issue? RBI has a role in intervention, that is, RBI can play a role in stabilizing the currency value. How? RBI sells dollar from its foreign exchange reserves to curb excessive rupee volatility. RBI sells dollars and buys rupees and keeps it with itself. So it will reduce the inflationary trend and reduce the currency value. Stabilize the currency value. This ensures that sharp depreciation does not destabilize the economy. Okay. Then mitigating inflationary pressures. That is, by stabilizing the rupee, RBI aims to control the rising cost of imports like crude oil, which may influence inflation. Okay, so one of the tools by which RBI can mitigate inflation is by using open market operations, that is selling and buying of bills. When you want to suck out the excess money, that is when there is inflation there will be excess money, so you want to suck out the monies. So when there is need to suck out the money, RBI is going to sell bonds. The bonds will be sold and money will be taken by the RBI. It will reduce or suck out the extra currency which is available in markets, reducing the inflation. And then, so RBI should also focus on maintaining investors' confidence. That is, it should focus on active forex management, which reassures investors about India's economic stability, supporting foreign investment inflows. Okay, what is the idea behind investing in a particular country? For private entities, that is, foreign entities or any private entities, the main aim of investing in a particular country is profit. When is profit ensured? Profit is ensured when the country is stable, when the country is economically strong, when there is less risk, and when there is higher returns. Okay, all these are possible when the currency of a particular country is very strong. Okay, so RBI in this aspect has to reassure these private institutions or private entities that the profit you want to get out of India is optimum, and all these factors which indicate the profit of a country profit of a corporation are stable. Okay, that is what RBI has to do. For this, RBI will use active forex management to show that India's economy is stable. Okay, so moving forward, what should be the ways? Diversifying export markets. Okay, so we have to increase our exports so that we can balance our trade deficit. Focus on expanding exports to non-traditional markets to boost foreign exchange inflows. That is, encouraging value-added exports to enhance competitiveness at the global level. Then, reducing the dependence on high-cost imports. That is, following austerity measures. Okay, that is, importing only those items which are very essential. Okay, so that when you are importing items which are very essential, then the forex reserve at your hands will be stable. But if you are using your dollar or the foreign currency which is present with you for importing petty items like food, etc., etc., then it is going to reduce the forex reserve and it is going to reduce the value of rupee. So invest in renewable energy and domestic oil production to reduce reliance on imported crude oil. Okay, we can reduce the import of crude oil and we can reduce the import bill as well. Then promoting domestic manufacturing of high value goods to cut import dependency. So in order to reduce the goods, we can follow austerity measures or we can improve upon our manufacturing base as well. Okay, then aligning the monetary policy with global trends. That is, RBI should closely coordinate with monetary policy to minimize interest rate differentials with the US Federal Reserve, so that there is not much of a stark difference, so that RBI should also be more demanding. Okay, RBI should also be more demanding, RBI should also be more attractive to investors. Then strengthening the economic fundamentals, that is, focusing on fiscal consolidation to boost macroeconomic stability. That is, reducing unnecessary expenditure or focusing on capital expenditure, reducing revenue expenditure, and also putting a curb on freebie culture. All these things can be a way in forward for reducing the value depreciation. Then addressing the structural bottlenecks to improve productivity and competitiveness. That is, the structural bottlenecks in the sense infrastructure, logistics, and other sectors. Then promoting FDI and FPI inflows. Okay, so the foreign direct investment and foreign portfolio investments are a very important source of investment in India. So those should be attracted more. That is, ensuring a conducive investment climate by simplifying regulations and offering policy clarity. Okay, with this way we can bring down the reduction in the value of rupee, and we can stabilize our rupee. Okay, so this ends our topic of the day today. If you have any doubts, you can write in the comment box. If you like the video, then please hit on the like button, comment on the video, as well as share with your friends. And if you are new to the channel, please subscribe to the channel and click on the bell icon so that you don't miss any notification. With this, I will end the video. Jai Hind.